Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So it is Saturday, and we're just going to do another velocity banking review. And what is velocity banking? All it is a debt payoff strategy where you use a line of credit as your main operating account. And if you really want to deconstruct it, just don't have any savings with the help of a line of credit. Okay? Dump all your money into debt. All right, so for today's review for our Saturday financial level up, we always kind of start off with the same process. Number one, having a budget. And number two, we need a line of credit. So as you can see here, we have what we call the average American's budget. And you know what? Instead of putting this in yellow, I should put this in red. Red and white font so we know that this is serious business. Because if you're making 8 grand a month, okay, and you have $7,000 of expenses and $1,400 left over in savings, you kind of feel a little sad about that. I don't know about you, but if I made this much money and only had about $1,500 left over, I'd be a little bummed out. Okay? Because why do we have only this much in savings? Too much debt. 6 credit cards, 2 auto loans, right? A student loan, and a mortgage, and then our general expenses, food, gas, insurance, and all that other good stuff, right? And so the whole point of this exercise is to make all of these go to zero, and we still have to pay our food, gas, insurance, right? But our debt is, if you really think about it, kind of optional, and we're going to make it go to zero so that we can increase what we call our cash flow. Now, let's go ahead and do the velocity banking side. So we just assume two things. Number one, same income. Number two, zero savings. And then with our expenses, right, we just copy our expenses. And then what we're going to do is have something called cash flow. So how does this work, right? Well, the whole idea and philosophy behind this is that we're not really going to have any savings until all of our debt is paid off. Now, you might decide once you have everything paid off, besides the mortgage, do you want to invest in real estate or not, which is what I did. But let's just assume for today that we're going to pay off all of our personal debt. Okay, just all of our personal debt. And I know a lot of people will freak out about this because when you tell the average person that you're not going to save any money, they freak out. It's so funny because the average person is broke, but when you tell them that they're not going to save money, like you're not going to save money, they feel very uh, anxious. I don't know if you ever felt that, like in a holiday party or in Thanksgiving, you tell your friends and family, I'm just not going to save money. I don't need 3, 6 months of savings. That's nonsense, right? And then they'll just kind of like freak out on you, okay? So this is what I mean by cash flow, but no savings. So if you take a look at this checking account summary right here, you see that the beginning balance is zero, and then the ending balance is zero. So doesn't that mean we did not save any money? Because whatever money we have, we just completely apply it to debt, right? We just completely apply it to debt. Okay, so let me go back here, and we're going to assume we have access to a line of credit. Okay, now the likelihood of you getting a line of credit at this stage is not high. Let's be honest, because why? At this stage, if you only have $1,500 left over because of all of this debt, even though you make decent income, the bank ain't going to lend you money because I now have to repeat myself. Banks don't lend money to people who need it. In fact, let me get the AI voice generator to say this too,
Remember, folks, banks don't lend money to people who need it. When you don't need money, credit is the gift that keeps on giving.
right? And the reason why I talked about credit is a gift that keeps on giving is because recently, where is it? I got $27,000 or $27,200 in new lines of credit. And this was as recent as yesterday, 12/6/2024. So if you're like, you just got lucky or whatever, I'm like, all right, well, I've been making these videos for about a year now, and I just keep making the same, like, level up videos. So I think I know what I'm talking about just a little bit. Okay. And the truth is that banks don't lend money to people who need it. And the reason why people don't understand this is because bank marketing, bank advertisement tells you the exact opposite, which is, hey, we're going to be there for you when you need us, right? Remember those like Chase commercials? Like, we're your local community bank, Chase, and we'll be there for you when you need us. And that's actually not true. they only there for people who don't need money, and then their hope is that that person who doesn't need money is eventually going to be bad at managing it, and then once that person goes from not needing money to needing money, that's when the bank is like, no thanks, we're not going to loan you anything else. Okay, so that's how they work. But I have over $575,000 in lines of credit. That's my current total credit limit, and I got two more credit lines. So let's go ahead and just quickly discuss what's a line of credit. All it is a financial tool where you could borrow money, pay it back, and then use it over and over again. And so I got oodles and oodles of credit. You saw the new credit lines, but I got a $280,000 home equity line of credit. It's pretty sweet. I just go to the bank's website, I click a button, and they say, hey, whatever this number is, this available balance, you can just dump it to your checking account and borrow it at actually a 7.75% interest rate. I looked it up yesterday on the website and said they were charging me 7.75%, which is weird because on the contract itself, it told me they'd charge 8. So I'm not complaining, right? But yeah, so I could literally go to a bank's website and click a button, and then it will appear on my checking account, which is pretty sweet. Okay, so now let's just assume we have access to maybe a $170,000 home equity line of credit. So basically, if you offer your home equity as collateral, the bank will say, "Hey, we'll lend you money in the form of a device or a financial instrument very similar to a credit card called a home equity line of credit, right?" And the even though a credit card is a line of credit, the reason why people love personal or home equity lines of credit so you can use it to pay anything. Like if you have like let's say an $80 balance and you owe $80 on the home equity line of credit, you can just borrow 80 and put it back again and payment resolved, right? Payment satisfied. That's the cool thing about it. So you could use it to pay anything. All right, so now let's just go ahead and get started. So again, for like I said, first two requirements is number one is the budget. Number two is your line of credit as our main operating account. So well, how much credit card debt do we have? I don't think it's 142,000. So let's go ahead and sum up how much we have. So this is 5 plus 8 plus 15 plus 27 plus 30 plus 7. That's $92,000 in lines of credit. 92,000. So 92000. Okay? 92,000. And guess what happens when we move this 92,000, kind of like a credit card balance transfer, into the line of credit? Well, these payments go to zero. Zero, 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 right? And look at that. How do we go from $1,495 in savings to no savings with $4,550 in cash flow? So what this cash flow number represents is the amount of the balance of the debt that will be reduced after every single month before interest. Okay, so we're going to go ahead and do that. And the way that we're going to do that is we're going to put our entire paycheck into that line of credit and does two things. It satisfies the minimum monthly payment and it lowers the interest because when you put the whole thing, then the balance is at its lowest. So you'll have a lower average daily balance. And then you take your expenses out of the line of credit. And actually, I don't directly use this to pay for my expenses. I actually use a credit card, but only up to this general $2,000 expense amount. And then as I'm paying off the debt, then I pay off the credit cards, right? There's a reason for this, which I'm not going to go over today, but paycheck in, expenses out, and that's all you got to need to know. So I2 plus 1, and then this is G2 plus H2 minus cash flow 450 over 28. So what does this mean? In order to get the next month's balance, you just take the previous month's balance, the previous month's interest, and then you minus the cash flow, this number right here, okay? And you see the next month, this will be the balance. And also, we have this column called savings account, so our emergency fund. So why is this the savings account? Because a lot of people freak out like, hey, shouldn't you actually save money? Shouldn't you save money? But if you take a look here, right, and if I had a checking account or a savings account where the end balance was like $1,000, I'd be freaking out because when we have money in a savings account, it's like idle money. It's like stale water, right? We want to either do one of two things, either actively pay off debt or actively invest, right? We just don't want savings because if you have debt and your savings rate is like 4%, but the average of your debt is like 9 to 10%, the bank is winning. And what we're trying to do is effectively make a return by eliminating all of our debt, right? That's one way we can think about this. Okay, so let me go ahead and go here, and so whatever, if we have emergency funds that goes beyond our budget, this is essentially our new savings account, which is the available limit minus the balance, right? So, all right. So now what we do is calculate the interest based on that average daily balance. Average daily balance multiplied by the interest rate, which is 0.08, and then you divide by 12, right? Because it's calculated monthly. And let's go ahead and calculate uh, the time to debt payoff. Okay. And then you see that our quote savings account on the right is just growing, growing, growing. And you see here in month 22, this is completely paid off. Oh my goodness, this is awesome. Can't believe how easy and awesome this is. Month 22. Month 22. My goodness, right? So 22 months, and we paid off 92K. 92K. So almost $100,000 of debt, our credit card debt, in less than 2 years. Okay. Now what we do is we take a look at these, right? And here's the crazy part, because this is an 8%. I keep forgetting about this. Like, this is a 12% used car loan. Because the interest rate is lower, I think it's safe to move this 17,000 as well, right? So let's actually do that. Why did I forget to do that? I don't know, but let's make this 0, right? And so now our cash flow is over $4,928, and let's move the $17,000 auto loan, okay? So equals plus 17000. And what's our cash flow? Our cash flow is 4928.44, right? And then now let's go ahead and do this. All right, so now this car loan was paid off in exactly two more months, right? So now, oh, that was so easy. Oh my goodness. Okay, so in 2 months it was completely paid off. It was completely paid off. I can't believe it. Wow. So 24 months to pay off how much? So the 92,000 plus 17, which is 109K. 109K. Oof, that was pretty sweet. All right. So now we have this auto loan at 6%, we have this student loan at 6.1, and then we have this mortgage at 3. So luckily we have this loan calculator to figure out what's up with everything. So this is now 0. This is 24. Whoopsie. 24, 24, 24, right? And this will tell us all the oodles and oodles of good stuff. So what's the current balance? What's the current, what we call the cash flow index? And the way that we can, as an easy way to figure out which debts to pay off, is using this cash flow index. So the lower the number, that's the one we want to pay off. And all this means is how much bang for your buck do you get off by moving this into the line of credit, right? So for example, if I move this $12,000 into the line of credit, I get about $400 back in my cash flow. But if I move 27,000 into the line of credit, I get actually less, right? So we want to move this first, get that cash flow, and then attack the other debt. So let's go ahead and move this 12 grand into that line of credit. And I'm going to do this. All right, so plus 12709.78. Okay. And why is the font so wonky? All right, there we go. All right, so now we move that into the line of credit, and guess what? Our cash flow increases by $386, and now our cash flow is above $5,315. This is amazing. Okay, so now let's go ahead and do that, and then now we're going to update our cash flow, which is 5315.09, right? Bam, bam, right? And then now here, okay, so what month is this? This is month 27, all right? So 27 months, actually I do this, 27 months, we paid off 129K. And then now we got our student loan and our mortgage, and so let me just take a look here, and so 27 months, 27, 27. Actually, this one is actually 0. Okay. And so now we see that our student loan is 27 grand and our mortgage is 209 grand. Now, why do we want to pay off the student loan first? Just because we get more bang for our buck in terms of cash flow. This cash flow index is a little bit higher than I'd like it to be, but it's okay. If you have a high cash flow index, then definitely don't put it in the line of credit like 225, but you can use something called the chunking method, which we'll go over. But let's for now move this one into the line of credit. So 27 grand into that line of credit, which we're going to go over here. All right, so let's do that. And then we're going to plus 27219.57. And now how much is our cash flow increased by? It right here, this is now 0. So it's increased by $5,000 to $5,683.12, right? $5,683.12. And then I'm going to paste this, and then I'm going to do this. 5,683.12. And all right. And now we're at month 32. Paid off. Sweet. Okay. So 32 months. 32 months. And how much is it? 129 plus 33. 162K. All right. So $162,000. That was pretty sweet. And now it's our mortgage. So if we go here, no, if we go here in 32 months, this is now 0. Balance is about $207,000. $207,000. Okay. Now let's just do a quick comparison. So in 32 months, how much of the principal did we pay off? It's 220 minus, okay, minus 207, right? So we paid off 13K in about 32 months. Pathetic, right? So, and actually take a look at how much interest we paid, about 17 grand. So let me just kind of go here. So let's do this. Let's move 13 grand into the line of credit, okay? 13 grand. How long is it going to take for us to pay off that 13 grand? 2 months. 2 months. Oh my goodness. Right? And let's just do this one more time. Another 2 months. So that's insane. I'm gonna take a look. So it took us 2 months to pay off this 13K when we did it in the line of credit at this stage, right? So I'm blown away, right? And then we just rinse and repeat over and over again. And then this is kind of hard to calculate what the debt payoff is because you're still making the monthly payment. But luckily, we got the Velocity Banking Calculator. And let me pull it up. Give you one moment. All right, so this is the Velocity Banking Calculator I always like to show off by Renatus. If you don't know what Renatus is, it's an educational company where you can learn about financial literacy and real estate investing. So this is where I originally learned Velocity Banking from. If you are interested in leveling up, so I know I talk about Velocity Banking here, but also learning about other things like understanding credit, finding the deal of the decade, creative real estate. This is a place to be. And I resell their education for a commission because I'm an independent contracted marketer. So full disclosure. And so this whole thing is a sales funnels to Renatus. But if you're interested in not only learning about Velocity Banking, go ahead and click the Google form link below. Okay, well, so I put this in. Let me just kind of go in here, make sure that make sure that I put in everything correctly. And then looks like I did. And whoa, 2.8 years. That is insane. Now let me just do this. I want to just do a quick comparison. What if I replace this with the first lien HELOC? Not good, right? Now it's not that bad because it's 26 grand, but take a look at this, okay? If I just do small chunks, I only paid 10 grand in interest or 9.5 grand. If I replace the mortgage with the line of credit, I paid 26 grand. No bueno. I don't need to do that. I'd rather pay in 2.8 years and do 9.5 grand. Okay? So let me just go ahead and do this. So where did I go? Where'd I go? I don't even know. This is too quick. 2.8 years, so it's 32. Divide by 12 plus 2.8, and that's 5.4 years debt free, right? And I know there are some of you out there with these low interest rate mortgages at 3%, and it's like, well, if you got a loan like this a couple years ago, think of how quickly you could pay it off if once you maximize your cash flow, and then you never have to pay what is the most expensive part of most people's budget, which is housing, right? And so, yeah, now we're 5 point years debt for 4 years debt free. Dang, how long did it take? 2.8 years to pay off the mortgage? Blown away. Are you blown away? Because I'm blown away. And I actually literally did this because if you're watching this channel for the first time, I paid off my mortgage under 3 years. I think it's 2.2 years and 9 months. Is that 2.8 years? I don't know. I'm just flexing, right? I'm just flexing. Where's my paid off mortgage? There it is. To about 2 years and 9 months. 2 years and 9 months. So is this possible? Possibly. I don't make any guarantees, but I did it. Can you? Okay. So, all right. Well, that's it for today. This is a Saturday debt financial level up. So, have a great day, everybody. And yeah, just man, just making the same video over and over again. But it's really exciting to see like paying off a house faster than most people pay off a car. 5 to 7 years for a car, and I paid it off paid off a house under 3 years. What a joke. Okay. All right. Well, that's it for today, everybody. It's Korean Atlanta Mentorship.